While everyone was panicking and dumping silver at the lows, the smart money was doing the exact opposite, and the chart just confirmed it. Silver is now sitting at a level that has marked major turning points before, and there's a specific price target coming up that could decide the next few months. Don't scroll past this one. Something just shifted beneath the surface of the gold market, and almost nobody talking about it right now understands what it means. A signal has appeared in the charts that, historically, has only shown up at the start of major rallies, not the end of declines, not a pause, but the beginning of a real move. If you own gold, silver, or mining stocks, or if you have been standing on the sidelines wondering whether the worst is over, the next few minutes will change how you see the next 90 days. Stay with me to the end, because the specific price levels where this rally runs into trouble, the exact numbers where gold and silver could stall, are coming, and they matter more than anything else in this video. There is an old and useful discipline, practiced by people who study history rather than headlines, of asking not what just happened, but what does this rhyme with? Markets, like nations, do not repeat themselves exactly, but they echo. And the echo we are hearing right now in gold and silver is loud enough to be worth your attention on this particular holiday weekend. A weekend, fittingly, that marks 250 years of a republic that has weathered panics, depressions, and currency crises far worse than anything on a stock chart today. Happy birthday, America. Now, to the gold. The first thing worth noticing, and the thing almost no casual observer bothers to look for, is called a positive divergence, and it is one of the more reliable tells in the entire discipline of technical analysis. Here is the plain version. When the price of a metal makes a new, lower low, but the shares of the companies that mine that metal refuse to follow it down, when the miners instead carve out a higher low, that disagreement between price and sentiment is rarely noise. It is signal. Gold made a lower low in recent weeks. Silver made a lower low in recent weeks. And yet the mining shares, both the larger producers and the smaller juniors, quietly refused to confirm that weakness, tracing higher lows instead. That is not a footnote. That is the market's own internal jury, returning a verdict before the price action has caught up with it. History offers a second piece of corroborating evidence, and this is where the picture gets genuinely interesting. Gold, across its long modern history, has staged exactly 3 major breakouts to new secular highs. Not 4, 3. And each of those 3 breakouts was followed, in time, by a serious corrective period, a shakeout designed to convince the majority that the bull market was over just before it resumed. The correction that unfolded through 2026 sits squarely on that historical scale, and when you lay it beside its predecessors, the current stabilization looks less like a coincidence and more like a pattern completing itself on schedule. Nobody can promise this becomes the explosive vertical move gold made in 1973. That would be the dream scenario, and dream scenarios are rarely the ones that arrive. The more sober comparison, the one grounded in the 2006 rebound, is the more likely template. A real, tradable, multi-month recovery, not an overnight moonshot. Now here is where the story widens into something far bigger than a summer trade, and it deserves your full attention because it reframes everything that follows. Consider gold not in isolation, but measured against the stock market, a ratio that has, across a full century, marked every one of history's great turning points. In 1980, in 1934, and again from 2001 through 2011, the secular peaks in gold were each preceded by an enormous rotation of capital out of equities and into the metal, moves on the order of 700% in the gold-to-stocks ratio. Massive, historic, era-defining flows of money fleeing paper promises for something that cannot be printed. The move gold has made against stocks in this most recent cycle comes to roughly 100%, real, but a fraction of the scale that has historically marked the final, blow-off top of a secular gold bull market. That distinction matters enormously, because it tells you plainly that whatever this recent gold cycle has been, it has not yet been the big one. The great rotation, the environment in which gold rises while stocks fall in tandem, the exact environment that historically drags gold toward extraordinary, once-in-a-generation price levels, has not even started yet. That case, and the number attached to it, is coming in the next few minutes, and it is bigger than almost anyone is currently prepared for. Before we get to the resistance levels, the sentiment data, and the specific price target most investors are not yet pricing in, understand what the recent bottom actually looked like on the chart, because it followed a script technical analysts recognize immediately. A market approaching a genuine low will often produce exactly one more lower low, a final, painful undercut that convinces the last remaining bulls to give up, that triggers the "we're going to 3,500, we're going to 2,900 chatter, that manufactures maximum pessimism at precisely the moment maximum pessimism is least justified. That lower low arrived, on schedule, in both gold and silver. It was a false new low, a trapdoor that opened and then quietly closed again. And once it closed, the market did exactly what markets tend to do after a capitulation like that. It stabilized, it based, and it turned. That turn is the one now underway. And what comes next? How far this rally can run, and where the resistance sits that could turn a rally into a trap of its own is what the rest of this video is built to answer. Do not look away yet, because the specific numbers are next, and they are the difference between riding this move with confidence and guessing blindly. So where precisely does this rally run out of road? That is not a rhetorical question. It has a specific answer, drawn directly from the chart, and it deserves the same rigor as everything that came before it. For gold, the first meaningful ceiling sits just under $4,400, the level of the last rebound's peak, reinforced by a prior low that marked the top of the range before the final leg of selling began. Layer onto that the 200-day moving average, currently sitting close to $4,460, and you have a tight band of resistance that this rally will need to work through. It would not be shocking if gold pushed slightly above that band and briefly fooled the crowd into thinking the breakout was already complete. Markets have a habit of doing precisely that kind of thing at moments of maximum attention. All told, the realistic upside case for gold over the coming weeks is on the order of $300 from current levels. Silver's math follows from gold's. With silver currently trading near $61, the first real resistance sits around $67, with a more significant ceiling just below $70. If gold delivers that $300 move, silver should have the fuel to reach the high 60s and press up toward that $70 line. For anyone holding silver explorers, developers, and producers, a $70 silver price is not a modest outcome. It is the kind of number that changes the economics of entire projects and entire companies. The weekly candles confirm the same story. The divergence and the sentiment data are already telling. 4 weeks back, gold produced a near miss on a bullish hammer, tentative buying stepping in at the lows. 3 weeks back came an inverted hammer, a failed rally attempt. But the last 2 weeks have each closed as clean bullish hammers, back to back, a signature of selling pressure steadily draining out of the market. Silver's version was slightly less textbook, a bottom closer to $52, right at a key moving average, would have been the cleaner technical picture. But silver still closed this week with its own bullish hammer, and the same $70 zone stands as the level that will decide whether this is a pause or a ceiling. Charts alone are only half the picture, and this is the part almost every casual market commentator skips entirely, the sentiment data, the part that tells you not what the price did, but what human beings were actually feeling and doing while it happened. And this is where it gets genuinely remarkable. Looking at the share of total ETF capital allocated to gold relative to all ETF capital everywhere, the number has barely budged even as gold pulled back sharply. Which tells you the money that left gold-backed funds like GLD in recent weeks was not casual profit-taking. It was capitulation. People were saying, in effect, "Get me out," at exactly the moment history says you should be doing the opposite. The Bank of America Monthly Fund Manager Survey tells the identical story from a different angle. The net percentage of professional fund managers calling gold overvalued fell to just 1%, the lowest reading in 2.5 years. And perhaps most remarkable of all is the family office data. 72% of family offices surveyed hold no gold whatsoever. Of the 28% that do, the average allocation is under 1% of total assets. Read that again. The people managing some of the largest pools of private wealth in the world are, as a group, functionally absent from gold. That is not what the end of a bull market looks like. That is what the early innings look like. If any part of this, the divergence, the historical analogs, the idea that gold and silver may be entering the early stages of a move that eventually challenges $10,000 an ounce for gold and $200 an ounce for silver, has been useful to you, this is the moment to hit subscribe, because the levels above and the sentiment shifts ahead are exactly the kind of thing that gets tracked and updated here every single week. And missing an update at a turning point like this one is the kind of mistake that is easy to avoid and expensive to make. For investors who want to go a step further than watching the charts from a distance, who want a curated, actively managed list of the specific mining companies being bought during this stabilization, the ones believed to carry 3 to 5 times upside over the next 2 or 3 years, that is precisely the work being done inside the Daily Gold Premium service, where every position discussed is a position actually held, dollar for dollar, alongside subscribers. It is available at thedailygold.com/premium, and to everyone already on board, Thank you for the trust. The final piece of evidence comes from the mining shares themselves, and it may be the most persuasive of all because it draws on a pattern that has now repeated across multiple full market cycles. Compare the current correction in the major gold miners index to the corrections of 2002, 2004, and 2006. Each of those declines ran roughly 5 months before finding a floor. Each one was followed by a rebound of 2 to 3 months, and the current setup, including what appears to be a double bottom in the miners' price action, lines up with that same rhythm almost point for point. There is one more layer to this, a breadth indicator that deserves its own moment, because it is the difference between a trade and a thesis. Look at the percentage of mining stocks trading above their 200-day moving average, a simple but powerful gauge of how broadly a decline has been felt across the sector. That reading recently fell below 10%, a level of exhaustion matched at only a handful of points across the entire 2002 to 2007 bull market. And here is the important nuance, the part that separates a disciplined read of the data from wishful thinking. Every time breadth reached this level of oversold extreme, a rebound followed, but not an instant, explosive, unabated move like the recoveries seen in 2008 or during the pandemic. Instead, the historical pattern shows something slower and more deliberate. 5 months from exhaustion to the next real advance in one instance, 10 months in another, 12 months in a third. The lesson is not that the bottom is fake. The lesson is that big, durable moves in this sector tend to take real time to build, and the summer rebound now underway is likely to be a genuine multi-month advance rather than a rocket ship, followed, quite possibly, by another period of consolidation into the fall before the sector sets up for its next, larger breakout. Which means the honest conclusion here is not, buy today and never think about it again. It is something more useful and more durable. This stabilization, with miners and juniors still sitting 30, 40, even 50% below their highs, represents a genuine entry point for a summer advance, and the data suggests a second, similarly attractive opportunity may present itself again later in the year, once this current rebound runs its course and the market resets for its next leg higher. That is not a contradiction. That is simply what disciplined, patient positioning inside a long secular bull market actually looks like, cycle after cycle, for those willing to hold good companies through the noise rather than trade every wiggle in the price. Before you close this video, there is one more thing worth understanding, and it has nothing to do with charts. It has to do with why most people, historically, never actually capture moves like this one, even when the evidence is sitting right in front of them. If you have ever wondered why the crowd is almost always wrong at the exact moments that matter most, this next part explains it, and it might be the most important few minutes in this entire video. Every generation likes to believe its own panic is unprecedented, and every generation is wrong about that in roughly the same way. Investors fled railroads in the 1870s, certain the age of rail was finished, only to watch railroads carry the country into its industrial century. They fled stocks in 1932, certain capitalism itself had failed, a few years before the greatest bull market of the century began building beneath their feet. They fled technology in 2002, convinced the internet had been a fraud all along, months before the companies that would define the next 20 years of American life quietly began their ascent. The pattern is not subtle once you have seen it enough times. The exit door is always most crowded, closest to the bottom, and the platform is always emptiest right before the train the crowd needed pulls back into the station. Gold and silver, in the moment we are living through right now, are simply the latest chapter in a story that is far older than either metal's current price. What makes this particular chapter unusual is not the panic. Panic is common. Panic is almost the default condition of markets at extremes, but the setting in which it is unfolding. This is not a bull market being cheered on by magazine covers and dinner party bragging. It is, by nearly every measure available, an unloved bull market. Family offices sitting on some of the largest and most sophisticated pools of capital in the world are, by their own admission, functionally uninvested. Fund managers, paid to be right about exactly this kind of question, have spent the better part of 2.5 years leaning the wrong way. That combination, real, structural underexposure among the people with the most capital to deploy, sitting on top of a technical setup that has repeated itself at every major low for the better part of a century, is not something that shows up often. When it does show up, it tends not to resolve quietly. None of this, it should be said clearly, is a license for recklessness. The single most common way investors lose money in a genuine bull market is not by being wrong about the direction, it is by being right about the direction and wrong about the sizing, the timing, or the patience required to stay in the position long enough for the thesis to actually play out. A rebound that takes several months to build, as the historical pattern suggests this one might, will test the resolve of anyone expecting a straight line. There will be pullbacks inside the rally, There will be days the miners give back a week's worth of gains in an afternoon, and financial television will declare the whole move over. That is not a flaw in the thesis. That is simply what the middle of every real move in this sector has always looked like, going back as far as the data exists. The investors who actually capture these cycles are rarely the most clever ones in the room. They are simply the ones who did their position sizing in advance, who understood the difference between a producer with cash flow and a speculative junior with none, and who built a plan sturdy enough to survive being tested by exactly the kind of volatility that shakes weaker hands loose. There is also a discipline worth borrowing from an entirely different field here, one that has nothing to do with markets. The historian's habit of distinguishing between what is merely loud and what is actually significant. The loudest voices around any market bottom are, without exception, the ones calling for further collapse, because capitulation is by definition the moment when fear is speaking loudest and conviction is speaking least. The quieter, harder to notice signals, a breath indicator falling to a decade-rare extreme, a survey of professional sentiment hitting a multi-year low, a divergence between the miners and the metal that has appeared at nearly every major turn for 25 years, do not shout. They simply sit there, waiting to be noticed by whoever bothers to look past the noise. That is, in the end, the entire purpose of an exercise like this one. Not to predict the future with certainty nobody actually possesses, but to notice, honestly and without flinching, what the historical record actually says tends to happen when this particular set of conditions has appeared before. So here is the real question worth sitting with after everything you have just seen. Are you positioned for the kind of decade-long rotation of capital that history says is only in its early stages? Or are you still watching from the sidelines, waiting for certainty that, by the time it arrives, will already be priced in? Say which one describes you in the comments below, and if you have your own view on where gold and silver are headed into the fall, put it there too. This is exactly the kind of conversation worth having out loud, together, before the next move plays out, rather than after. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk.